Hello students, this is the course of managerial accounting. My name is Dr. Amer Shalak in الأكاديمية العربية الدولية. So, first, the purpose of a business. Peter Drucker, an eminent management thinker, has argued that the purpose of business is to create and keep a customer. Simply. So, the main purpose of any business is to simply have customers. We have two types of customers. We have potential customers and we have current customers. So, our purpose is to create a customer, meaning to attract this customer, to have it, to obtain this customer, which was a potential, and then we are going to transform it to a current customer. And of course, we should keep this customer and work on the attractions of other customers. Drucker defined the purpose of a business in this way in 1967, at a time when most businesses did not adopt this strong customer focus. His view, therefore, represented a radical challenge to the accepted view of what businesses do. 45 years on, however, his approach has become part of the conventional wisdom. It's now widely recognized that in order to succeed, businesses must focus on satisfying the needs of the customer. So back in days in 1967, customer was not the main focus of the businesses. But after business management and business studies has progressed, now we can say that the customer is becoming the center of the circle, is becoming the point of attraction, and the businesses are working as much as possible to satisfy the customer needs in order to be successful. Although the customer has always provided the main source of revenue for a business, this has often been taken for granted. In the past, too many businesses have assumed that the customer would readily accept whatever services or products were on offer. When competition was weak and customers were passive, businesses could operate under this assumption and still make a profit. However, the era of weak competition has passed. Today, customers have much greater choice and are much more assertive concerning their needs. So, in other words, simply today competition is much worse than previously. We will need to work harder in order to satisfy customer needs. Too many competitors, too many market shares. We should be able to get as many market shares as we can from the market, and in order to do that we should be able to compete. So there we should be able to satisfy the customer needs and we should be able to understand how to do so. So how are businesses organized? Nearly all businesses that involve more than a few owners or employees are set up as limited companies. So what are we saying over here? We are saying that Almost all businesses that have more than a few owners and or employees are set as limited companies. This means that the finance will come from the owners, the shareholders, both in the form of a direct cash investment to buy shares in the ownership of the business and through the shareholders allowing past profits, which belong to them, to be reinvested in the business. So it's simply we have two ways in order to add cash to the business. First of all, we can directly invest cash, so just like buying shares or maybe giving some financial resources to the business itself, or simply by reinvesting the cash in the business in order to make more profit and simply which is going to be belong to who? To the shareholders themselves. So it's going to return to the shareholder after all. Finance will also come from lenders, like banks for example, who earn interest on their loans, and from suppliers of goods and services being prepared to supply on credit, with payment occurring a month or so after the date of supply, usually on an interest-free basis. In general, also we have another way in order to finance a company. Simply we can take let's say credit from a bank. Simply okay, banks give you money, but after all you will need to pay interest for this, so it's not for free. And we can also buy supplies on credit, but this also can come with interest rate or cannot. It's based on the offer, it's based on the contract signed with the supplier. And of course the terms of payment can be for the favor of the company based on the contract, of course. So how are businesses managed? Over the past 2 decades, the environment in which businesses operate has become increasingly turbulent and competitive. And this is what we were saying in the previous slides. So we are not now in the middle 19th century, we are not now in the middle of the 20th century. Now we are talking about more businesses, more competitors, new marketing strategies, new marketing idea, new competitions. So that's why we will need to upgrade with this. Various reasons have been identified to explain these changes. What are those reasons? First of all, the increasing sophistication of customers. So nowadays the customer is not that simple. Nowadays the customer has its own personality, has its own way of thinking, has too many choices to choose from. So that's why he is now much more sophisticated. In order to satisfy this customer, I need to work harder. I need to understand his mentality. I need to understand his needs much more, and then I can say that I have been able to attract this customer. The second point is that the development of a global economy where national frontiers have become less important. So nowadays, when we talk about globalization is simply just like deleting or erasing all of the national frontiers from the map. So over here we can consider the world to be a whole market in where we can simply work and make profit, do business, but this came with an expense. Small businesses nowadays cannot compete with big businesses, the huge businesses that actually has much more assets, have much more capital, and there they will be in a need to upgrade, in need to work harder, in need to work smarter to be able to sustain. The third point is the rapid changes in technology. So technology is actually upgrading very fast. It's going uphill. We will need to understand that. We will need to follow that. In order to follow it, you will need to pay money. You will need to invest. You will need to understand and you will need, of course, to open new departments where you will be able then to survive in the market. The fourth point, the deregulation of domestic markets, for example, electricity, water, and gas. So we know the term regulation. Now we are talking about the deregulation. Over here, we simply are giving it to the private sector in other terms, if we want to say it. So electricity, water, and gas are not only owned by government anymore. We can work on the private sector there. So this is also much more competition. This is a new thing to go through, and therefore it's causing the business in general to go more complex. Another point says increasing pressure from owners, shareholders for competitive economic returns. So this is a very simple point, simple in thinking, simple in saying, but it's actually causing complexity in general to the business. What do I mean by this? Simply, any shareholder means owner, means investor, is actually is investing in order to have a return, and he is expecting that this return should be somehow a fixed percentage, maybe monthly, maybe yearly. Okay, it's based on the contract, but he is expecting to have fixed revenues after all, fixed returns. So in order to maintain this investor or the shareholder in general, in order to keep him investing, in order to keep his money in the company's capital, we will need to please him, we will need to satisfy him with this return. And this is also what? This is money going from the company. So therefore, we will need to be able to maintain the balance between the the investors and the revenues. Means we should be able to go through profitable investments, and there we should be able then to survive in the market. The last point said that the increasing volatility of financial markets. Nowadays, financial markets are not so friendly. Financial markets are so hard, are not that easy to go through. So we will need to be very focused, very careful. We will need to study all of the risks around us. We will need to be able to survive those risks. So when we talk about setting the financial aims and objectives, within a market economy, there are strong competitive forces at work to ensure that failure to enhance shareholder wealth will not be tolerated for long. Competition for the funds provided by shareholders and competition for managers' jobs will normally mean that shareholders' interests will prevail. If the managers do not provide the expected increase in shareholder wealth, the shareholders have the power to replace the existing management team with a new team that is more responsive to shareholders' needs. What do we mean by this? Simply, within this market that we have already talked about, that we have already explained a little bit, its volatility, its complexity, shareholders and investors are searching for their revenues, for their returns, for the best for the company after all. So in order to do that, we will need to be able to survive, to compete, and to earn much more market shares. This is the job of who? This is the job of the managers. So if the managers were not able to maintain the performance and to exceed even the expectations of the shareholders, there the shareholders are able simply to replace those managers with new ones that are able to do the job as seen from the shareholders' point of view. So now we reach our main point. What is managerial accounting? Having considered what businesses are and how they are organized and managed, we can now turn our attention to the role of management accounting. A useful starting point for our discussion is to acknowledge the general role of accounting, which is to help people make informed business decisions. All forms of accounting, including management or, in other words, managerial accounting, are concerned with collecting and analyzing financial information and then communicating those information to those who make decisions. This decision-making perspective of accounting provides the theme for the book and shapes the way that we deal with each topic. So simply, managerial accounting is one very important way that we can use in order to calculate where are we right now, where have we been earlier, and where we might be going in the future. And it's a starting point where we can have some numbers that can give us a little bit uh, what situation we are in right now, and if is the company going uphill or is it going downhill actually. And those information of course should be given to the management team and of course to the shareholders who are going to understand those information in a way that give them an idea about where are they going. For accounting information to be useful for decision making, the accountant must be clear about for whom the information is being prepared and for what purpose it will be used. In practice, there are various groups of people, known as user groups, with an interest in a particular organization in the sense of needing to make decisions about that organization. So when we speak about accounting information, over here we will need to understand to whom are we going to present those information, who is in need of those information, what is he going to do with it. Is it the management? Is it the shareholders? Is it the accounting team? Is it some other maybe team or some other personnel that are interested in those information in somehow in their own decision making, of course, which is related to the company itself. So there, each one of them must be given the correct information based on his need. And there it's the work of the accounting information and it's the work of the accountant itself who must be clear with that. So providing a service. Simply, let's talk about 2 points over here. We have relevance and we have reliability. What about relevance? Management accounting information must have the ability to influence decisions. Unless this characteristic is present, there is really no point in producing the information. So simply, if the information that we are working on with the management accounting information, if there is no influence with those information, if there is no need for those information, so in order to need those information must be able to be taken into consideration, and that's why there's no really a point to have those information if there is no influence for them. This means that the information should be targeted at the requirements of individual managers for whom it's being provided. That's why we should work on, and that's what we have been saying in the previous slide, we should be understanding as accountants why are the managers asking for this information, how are they going to use it, why do they need it. Okay, then we should be able to provide them with the correct information they are actually in need of to take the correct decision. Otherwise, we are useless. The information is going to be useless for them. Reports that are general in nature are likely to be unhelpful to most of managers. Again, we cannot just simply give them general reports that we can provide them with and any other part of the company. They should have specific information that they need. To be able to influence a decision, the information must be available when the decision needs to be made. To be relevant, therefore, information must be timely. That means we should always be ready. Whenever managers need a piece of information, we as accountants should be able to provide them with this information, with this specific information, with this exact information. There we are now useful for them. The second point, which is reliability. Management accounting should be free from significant errors or bias. So what is bias? Bias is simply when we are doing wrong information, when we are working with wrong information. Over here we are providing wrong data to the managers, and therefore they will be taking wrong decisions, which is a very big problem for the company. Okay, it's a problem for the company. After all, it's going to be a problem for us as accountant, for the managers themselves in front of the shareholders. It should be capable of being relied upon by managers to represent what is supposed to be represented. It should be there. It should be able to provide them with the correct and used and needed information in order for them to do whatever they are supposed to do. So both relevance and reliability are very important. The problem that we often face in accounting is that information that is highly relevant may not be very reliable. So simply, it's a problem that is often faced in accounting, that the higher the information in the hierarchy of importance, the highest the risk of having faulty information. So as much as the information is important, as higher as the risk. That's why we will need to be very careful. We will need to be very exact with the information that we are providing to the manager in order to provide them with the correct piece of information they need. There they will be able to understand and to take the correct decision. And of course, it's going to be on time. Similarly, that which is reliable may not be relevant. Now, what about weighing up the costs and benefits? To illustrate the practical problems of establishing the value of information, suppose that we wish to have the damaged bodywork of car repaired at a local garage. We know that the nearest garage would charge, let's say, $250, but believe that other local garage may offer the same service for a lower price. So over here, simply in our head, we consider, no, let's go to the lowest price possible. Of course, yeah, let's save some money. Wait a second. The only way of finding out the prices of other garages is to visit them so that they can see the extent of the damage. So we cannot yet know the exact amount that we should pay in other garages unless we go there and we visit those garages so that they can examine the damage for the car, and there they are going to give us maybe a smaller number, of course, but they will need after all to see the car. Visiting those garages will involve using some petrol and will take up some of our time. Don't forget, time is money. Is it worth the cost of finding out the price for the job at the various local garages? The answer, as we have seen, is that if the cost of discovering the price is less than the potential benefit, it's worth having that information. So there we should calculate somehow in our heads the cost of discovering those prices. Is those garages those other garages that we are talking about, are they pretty far away? Are we going to consume a lot of petrol to reach them? Are we going to consume a lot of time to reach them? Or maybe they are a little bit near to us, though there we are not actually paying a lot of money to visit them, and there they will be able to examine our car and give us the right amount. So if the cost that we are going to pay for those visits to those garages is actually smaller, lower than the benefits that we are going to have, if we understand and if we know the numbers that they are going to ask us from, there we can say that okay, it is worth having those information. To identify the various prices for the job, there are various points to be considered, including how many garages shall we visit. If I'm going to do a body job for my car, maybe for $250, I'm not going to visit, let's say, 20 garages. I think that I'm going to pay much more money than the total cost itself for the petrol. I'm going to waste a lot of time, a lot of days going through those garages in order to see who gives me the best deal. So the number of garages that I'm going to visit must be, of course, be reasonable. What is the cost of petrol to visit each garage? How far is that garage? Am I going to spend a lot of petrol to reach it? Is that garage pretty far away? How long will it take to make all the garage visits? So again, time is money. I cannot simply go and visit all of those garages, stop everything that I'm doing in order to do that tour, losing my time out of the work, out of investing my money, out of doing the things that I should be doing in order to visit those garages. So is it going to take long? Are those garages pretty far away? Are those garages pretty numerous? How much do we value our time? That means, in other terms, how much do our time actually cost? Are we able to spend this amount of time on visiting those garages? Is it profitable? Is my time valuable? How much valuable is it? The economic benefit of having the information on the price of the job is probably even harder to assess. The following points therefore need to be considered. What is the cheapest price that we might be quoted for the job? And how likely is it that we shall be quoted prices cheaper than $250? There I'm saying simply, what can be the cheapest price? If the local garage tells me that he wants $250, okay, the other one, is he supposed, let's say, to give me $150? Well, okay, this is profitable. But if he is going to tell me, okay, I'm going to do it for you for $245, it's actually only $5 there. It's not worth, right? How likely am I going to have cheaper price? Not only how cheap, how likely am I going to have it? Yeah, it might be all the two. I might spend all of those petrol and time, but after all, I might get nothing. So that's why I should be able to understand and to weigh the cost and the benefits. As we can imagine, the answers to these questions may be far from clear. Of course, we were to contact all of the garages and find out all of the prices. We should know whether the exercise had been cost effective. Unfortunately, we cannot know this for certain in advance. We need to make a judgment. When assessing the value of accounting information, we are confronted with similar problems. So that's why we have explained actually the car and the garages point over here while weighing up the costs and benefits, because we will need to make such judgments and we will need to make such decisions when we are assessing the accounting information. We cannot simply visit all of the garages. Okay? We might not be able to have all of the costs, but there we are going to do our best, and then we should make the best judgment possible. The provision of management accounting information can be very costly. However, the costs are often difficult to quantify. The direct, out-of-pocket costs, such as salaries of accounting staff, are not really a problem to put a price on, but these are only part of the total costs involved. There are also less direct costs, such as the costs of the manager time spent on analyzing and interpreting the information contained in reports. So there, when we are providing the accounting information reports for the managers are actually spending their time reading those reports, and that's why we have said earlier it's very important for those reports to be timely, to be exact and correct. Time of the managers is not that cheap. Okay, then we should also consider that the accounting team who is actually preparing those reports is actually costing the company money, their salaries, and we can consider the salaries of the accounting staff to be a direct cost, but we have also other indirect costs other than the manager's time. The information gathering is sometimes costly, so all of those should be weighed up and compared with benefits that we should, or we actually think that we are going to have after preparing those reports. So what about managerial accounting as an information system? Management accounting is a part of the business total information system. That's what we have been saying. There is too many ways of having the information. One of those ways is the management accounting. There, we are providing information to the management staff that is going to take decisions based on this information we have provided. And of course, this management have other ways. Managers have to make decisions concerning the allocation of scarce economic resources to try to ensure that these resources are allocated in the most efficient manner. Managers require economic information on which to base their decision. It's the role of the management accounting system to provide that information, and this will involve information gathering and communication. So what are we saying over here? We're saying that managers have scarce resources. Scarce resources means has limited resources that is being given to unlimited demand. This is what scarce resources mean. And while doing this, managers then should take the best decision possible in order to do this in the most efficient and effective way for the company. That's why they ask for concise and correct information from the management accounting team. And that's why the management accounting team should be able to gather this information and should be able to explain it, present it, give it in the ultimate way to the management team, and of course being able to communicate it with the management team to represent it in order to achieve the best for the company. The management accounting information system has certain features that are common to all information systems within a business. Just like any other information system, we have identifying and capturing relevant information. In this case, of course, when we are talking about managerial accounting, we are talking about the economic information. We should be able to identify the correct information, the needed information, and then we should be able to capture this relevant piece of information. We have recording the information collected in a systematic manner. We cannot simply record this information in a general manner, in a random manner. We should be doing this systematically in a way that ensure that this information is there, is timely, and whenever we will need it, we will find it. Analyzing and interpreting the information collected, and this is a very important point over here. The management accounting team should be able to analyze and interpret the information that have been collected in a way that makes sure and ensure that this information is correct, this information is useful. What do I mean by useful? Useful means this information is working nowadays. So some information may simply get outdated. We don't need it anymore. Some information may not be yet needed. So what I want information that I'm going to use right now whenever I want, and this information should be exact, should be correct, should be useful. This is the very important point. We have reporting the information in a manner that suits the need of individual managers. This is the last point there. It's a very important one too. We should be able to report the information. We should be able to communicate this information with the managers in the best way possible that suits their needs, that satisfy them, that gives them the tools they need in order to take the correct decision there for the best of the company. What about influencing managers' behavior? Management accounting information is intended to have an effect on the behavior of those working in the business. The reason for providing the information is to improve the quality of the decisions. This should lead to actions that better contribute to the fulfillment of the business objectives. In some cases, however, the behavior change caused by management accounting is not beneficial. One possible effect is that managers and employees will concentrate their attention and efforts on the aspects of the business that are being measured and will give much less attention to the items that are not. It's said that the things that count are the things that get counted. This rather narrow view, however, can have undesirable consequences for the business, which can often arise where a particular measure is being used or is perceived as being used as a basis for evaluating performance. So this is the importance of the management accounting information. That's why it can influence the manager's behavior. It's very important to know that those information are a way to evaluate the performance of the company, is a way to evaluate, are our decisions, are the management decisions doing good job, are we going up, is the business working good? Maybe we are having a narrow view, we are not seeing the wrongs. The management information system, the accounting information system is there to make me see those wrongs, to make me correct those wrongs in order to preserve the best and the ultimate decision for the company. So what is managerial accounting and financial accounting? Management accounting is one of two main strands in accounting. The other strand is financial accounting. The difference between the two is based on the user groups to which each is addressed. Management accounting seeks to meet the needs of managers, as by its name, whereas financial accounting seeks to meet the accounting needs of the other users that were identified earlier in. The difference in their targeted user groups has led to each strand of accounting developing along different lines. The main area of difference are nature of the reports produced. Of course, one is targeting the management level, one is targeting other levels, so the nature of the reports are going to be different, level of detail is going to be different, regulations are going to be different, time orientation and range and quality of information, of course, are going to be different in between management accounting and financial accounting.